The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, the man whose market value only goes up and to the right. It's Anthony McDonald. How are you, Anthony?
I'd be further to the right if I was a Murdoch, James.
Indeed. Well, this week we explain why the big banks are suddenly slashing jobs, we examine the Murdoch family's succession peace deal, and we ask why some of our biggest companies are getting speeding tickets from the corporate cop.
But first, James, speaking of things that go up and to the right, how was the extraordinary rise in the share price of tech giant Oracle on Wednesday night? Its market capitalisation surged 36% or $321 billion in a single trading session after it told investors that it expects its AI infrastructure revenue will surge almost tenfold in the next 4 years. James, this is a crazy move in a huge company. Is it the next leg of the AI boom or the peak of the AI bubble?
Oh, well, you know what Mr. Bear would suggest, that it's the peak of the AI bubble.
The world's going to end?
But look, I think every time we think we're at the peak of the AI bubble, another bit of the AI bubble just gets bigger. So it's foolish to think that this is the end, but man, it's extraordinary. So Oracle's been around forever, run by its 81-year-old co-founder and executive chairman Larry Ellison, who briefly became the world's richest man, surpassing Elon Musk after that big jump in Oracle's share price on Wednesday night. But this is an old-school tech company, mainly known for its software. It's getting into AI infrastructure. And guess what? The roads are paved with gold. So it comes out on Tuesday night after the market closed and says, yeah, look, our revenue's pretty good, but we think in 2026, the current financial year, our cloud infrastructure revenue is going to jump 77% to $18 billion. And then by 2029, that $18 billion is going to turn into $144 billion.
Whoa.
And the market just went, you beauty, how good does this sound? Now, Anthony, I don't know about you, but I don't know many companies that can predict what's going to happen in 4 months' time. And I certainly don't know what I'm going to be doing in 4 weeks' time. So how on earth Oracle can say, oh yeah, we're definitely going to hit this revenue number in 4 years' time is completely beyond me. I mean, imagine all the stuff that's happened in the last 4 years. Pandemic, recessions, Donald Trump, and yet here it is saying with precision, we're going to hit $144 billion US in revenue in 4 years' time. Please, spare me. But investors just love this stuff. All they want to see at the moment, Anthony, is signs of momentum, signs that things are going up, and they just piled into this stock. Now, you do occasionally get stocks jumping 36% in a day, but they're never stocks of this size. This is a company worth $500 billion, or it was. Now it's almost worth $1 trillion. And you just don't see this stuff. I don't know. Does it feel a bit toppy to you?
100%, James, but it's the momentum, isn't it? It's the quants, the computers, the algorithmic traders. They don't consider valuation. It's just share price momentum. So if the company's worth $100 today, even if that implies a ridiculous multiple, a ridiculous price for the business, if there's an earnings upgrade and earnings are going north, their share price is going north, and it just amplifies all the moves. So you get a situation where expensive companies, and Oracle at 36 times next year's forecast profit, it's definitely not in the cheap territory, can get mega expensive really, really quickly. The pace of the moves is insane.
Yeah. Now, Anthony, on a similar theme, Oracle's not the only company that's seen its shares move in a big way over the last few weeks, and listeners will remember that during the August reporting season, we had several moves on the ASX where a company would jump or fall up to 20% in response to their profits, sometimes when they excite the market, usually when they disappoint the market. Now, those big moves, they don't go unnoticed by the ASX in its role as market operator, and they, after they see one of these big moves, they issue a please explain letter, which is known in the financial market here as a speeding ticket. And Anthony, we've seen a flood of them in the last week. Why did your share price go up? What can you tell us about your forecasts? How are investors reacting to these speeding tickets?
James, something's changed. I swear, and I apologise to readers. Like, I've been writing about this for 4 weeks now, and I'm sure it's getting boring. But seriously, I can't speak to anyone in markets, investment banking, investors, without them talking about how much the game's changed. Like, investors they're struggling to work it out. And this week it became apparent that the ASX, like you said, as the market operator, they're struggling to work it out too. I mean, as the market operator, it's responsible for making sure that companies are on top of their continuous disclosure, that they've disclosed things that are material to the market in a timely fashion.
Yep.
Yet companies are apparently doing this, and still their share prices are jumping 20%, falling 20%, which doesn't really make much sense. So I went back and I found 11 of the top 200 stocks where they'd been issued these ASX speeding tickets, James, which, they're quite formal letters that the companies have to respond to extremely seriously.
Yep.
And in those letters, I mean, the companies make it pretty clear that they're struggling to explain the moves. Nearly all of them didn't have formal guidance in the market for the FY25 numbers. I mean, that's a bit of a problem. There's also plenty of debate about what market expectations or the consensus numbers, as they're called, what they are. I mean, that's another chestnut topic.
Yep.
And yet their share prices were smashed. So they're struggling. The question, though, James, as this problem gets bigger, as things get more volatile, as there's more fast money in the markets, the question is there something wrong with the ASX monitoring system? Is it out of date? Can it not cope with the change in the market structure? Is there something wrong with investor relations functions? Like, companies, what they've been saying in their previous statements, is that not getting through to investors anymore because the nature of investors have changed? If not, what are they going to do about it?
Yep.
Are the companies, and perhaps even us, investors, too focused on these short-term share price moves? Is there ever a world where we need to overlook a quick share price spike or fall and just say, oh, that's just the computers?
Look, I mean, if a share's moving 5% or maybe even 6 or 7%, maybe you might overlook this stuff. But I think we saw some 15, 20% moves during profit season. Sorry, it's hard to get over those. And a lot of them have held, like, James Hardie and CSL are still really in the doghouse with investors. So the moves matter, don't they?
I agree. Now, James, I cannot let you go without asking you about this week's WTF big number. Came out on Friday morning. Virgin Australia's former CEO, Jane Herdlicker, had a $50 million payday in their financial year just gone. Sounds like pretty good coin for the co-pilot, doesn't it?
Oh, it's very good coin for the co-pilot. I mean, this is... We talk about on the podcast a bit, Anthony, private equity. It's a pretty sort of murky world, Everything happens away from the glare of public markets. There's no please explain letters from the ASX. You just get on and do things. And I think that the sort of mantra of private equity is take big risks, do big things, make big money. So we know that when Bain brought Virgin back to the ASX in June, they did really well. They made 3.5 times their money in terms of cash return.
Yep.
If they were able to sell their stake in Virgin, which is worth about $1 billion, that would go up to 5.5 times. That is a seriously big return.
Yep.
And so I guess we shouldn't be surprised that Jane Herdlicker, who was the CEO through that period, Bain brought the company out of administration and then grew it, turned it round, got it ready for the IPO. She's done very well too. I mean, the headline number in the Virgin annual report that came out on Friday morning says that in 2025 she got paid $49.9 million.
Solid.
It's a lot of money. No two ways about it. About $20 million of that is cash bonuses and her salary, which her salary is actually pretty small compared to some ASX CEOs, but yeah, big cash bonuses. The other 29 million or so is from the value of her shares in Virgin that she was granted as part of the private equity deal. Now, that's a pretty standard way that private equity works. The management team's incentivized to win when the private equity firm wins, and they're incentivized through the granting of equity. Now, actually, Anthony, if you value Herdlicker's shares at what they're worth today, and if you throw in the loan forgiveness, because the private equity works that the management are given a loan to buy the shares, and in this case, that loan was forgiven, I think the pay packet's actually more like $60 million, $62 million on my numbers.
You beauty.
So it's a lot of money. But this is the thing about private equity. take big risks, play big games, win big prizes. It's a different model. It's not the model we're totally used to on the ASX, but it's proven to be a pretty successful model in this case and in plenty of other cases. So it's actually quite interesting to get a look at how the sausage is made in private equity in this case.
Yeah, there's a lot of blood, sweat and tears behind that 50 or 60 million bucks, James. I mean, that's probably what doesn't come out in Virgin's annual report today, and it is performance-based. Like you said, it's, Jane only wins when Bain, the then owner, wins, and now Virgin's other shareholders as well. I mean, it's huge money, but the fact it's performance-linked, I mean, I think that's the main thing. The one thing about Virgin that will sort of, stick in people's heads is this was sort of government assisted as well. It's that post-pandemic timing. So, Jane's timing and Bain's timing as well was also perfect, right?
Yeah,
so I think,
absolutely.
They got lucky there as well.
With the benefit of hindsight, knowing what we know now about travel demand and the structure of the industry and how quickly we'd find vaccines for COVID, this looks like the easiest thing in the world. But back in 2020, 2021, even into 2022, when half the country was locked down, I bet it didn't feel quite as risk-free as it might look now. And I think that's the key point. All right, Anthony, let's get to our first topic of the week. And on our last episode, we mentioned how excited we were for the AFR's Asia Summit, which was held in Sydney on Tuesday, and which marked the first outing of ANZ Chief Executive Nuno Matos, who's attracted plenty of attention since taking the top job at the bank back in May. Well, an already exciting moment was made even more exciting when ANZ announced on Tuesday morning, just a few hours before I was due to interview Nuno on stage, that it was cutting 3,500 jobs and another 1,000 contractors. Now, this made for a pretty sort of dramatic moment when Nuno got up on stage. So let's take you inside the summit ballroom. Here's what Matos had to say about that decision.
Well, first, this is a very tough decision, very tough to the impacted people. This is about simplifying the company. This is about getting the basic things right in our company. It's about avoiding duplication, reducing complexity on one hand, and on the other hand, it's about stopping projects and initiatives that don't align with our priorities. But above all, it's about acknowledging this is very difficult news for our people. ANZ is a great company. It has great people, great businesses, great franchise of customers. That does not mean that we don't have to take decisions.
Anthony's basically saying here, this isn't a nice thing to do, but it's for the good of the greater bank. Do you buy that?
I do buy that, James. I mean, ANZ's probably had as many people in its retail bank as Commonwealth Bank, and it's half the size in terms of customers, loans. I mean, it's just added Suncorp Bank. That's nearly 3,000 staff. It's promised not to cut those jobs for the first 3 years of its ownership. So it's making its overall banking operations much bigger. At a time when ANZ's under immense pressure, bank margins, return on equity are nowhere near what they used to be. We talk about this all the time.
Yeah.
ANZ has the lowest return on tangible equity out of the big four banks. It has the lowest revenue to risk-weighted assets ratio, so it brings in the least amount of revenue per loan. It's got a lower headline net interest margin. So if you break it down by division, James, ANZ really struggles to make money in the consumer banking side of things as well, which doesn't make it unique. Westpac and NAB are a bit the same.
Yeah.
ANZ tends to do better in New Zealand than in institutional banking. But when you're under revenue pressure, you still want to grow earnings. You want to grow return on equity. You want to grow your value for shareholders. So what do?
Yep.
You got to target the costs, don't you? So Nuno's come in and he's going hard. I mean, there's been reports for weeks now that he's going to take a heap of jobs out of the business.
Yeah.
And on Tuesday, they really just ripped the Band-Aid off. Put a number, sort of took control of the story a little bit more. 3,500 job cuts, like you said, another 1,000 contractors. It's hard to think of a bigger corporate Australia job cuts program on the ASX, James. So I do question, though, how this is going to go for Nuno. He's an outsider, great career, working globally. Been here for a couple of months now and seriously swung the axe. I get why. I get that ANZ's bloated. I get how its numbers stack up against its rivals. But to do this in such a big way, I really hope for him that he's got a really core, stable group of 10, 20, 30 execs in there who are full believers in the program, are really going to push this ethos and these cuts down through the organisation. Because if not, it could get isolated pretty quickly. It's so easy on the outside, as it is for investors, to be like, yep, right thing to do, put the broom through the joint. But remember, it's just another business with a delicate juggle, isn't it, between those customers, employees and shareholders. And, normally if you get the customers and employees right, the shareholders are sweet. James, what did you make of Nuno? This was the first time we'd really seen him in the wild, so to speak. And it wasn't an easy backdrop.
No, it was a really difficult day. I mean, I think Anthony, in hindsight, he agreed to appear at the Asia Summit in perhaps a different time.
To talk about Asia, you mean?
Yeah. And I think, he was hoping we'd have a nice, polite chat about Asia. But of course, he came ready to answer the questions.
Yeah.
I thought, and he would say this, of course, but the first thought was for the employees. Interestingly, I thought it was good that he mentioned the employees' families. Mm-hmm. He acknowledged that this has a ripple effect across families, which is absolutely right and absolutely right to acknowledge. So I thought that was a good sign. My sense, though, Anthony, is he's got a very strong view here that ANZ needs to be shaken up. And it needs to be shaken up very quickly because it has fallen behind the rest of the pack. And if something doesn't change, it will continue to fall behind the rest of the pack. So I think he's sort of not for turning on that message. I think he knows he's not going to win a whole lot of friends early in this period. But to your point about ripping the Band-Aid off, this is what you got to do when you're coming in to change an organisation. It's not pleasant at the start, but you try and get through it quickly. He talked about, minimising the anxiety, getting this done, getting on to the rest of the restructure and hopefully eventually growth. So he's a different cat to some of the other CEOs out there. A much more worldly banker. He's worked in 10 countries, Mexico, Asia, lots of places in between. So it'll be a really interesting guy to follow. And I think you're right. It'll be really interesting to chart that journey from sort of the cost-cutting part of this, the sort of ruthless, difficult part of it to what we get next. There's a big strategy day planned for October 13 at ANZ, and I think that'll be closely watched to see the other part of the story here. What's interesting, Anthony, just a day later, NAB announced that it was making 410 staff redundant from its IT teams. Why do you think we're getting a rush of these job cuts? There were some job cuts at Bendigo Bank this week too, out of their IT teams. Is this a cyclical thing? Do the banks, everyone talks about the banks moving as a sort of one block. Is this more proof of that?
James, the banks are all under extreme pressure. There's half a dozen reasons, but the banks, as more broadly, as a collective, they're all going through these pressures at the same time. Like I said before, like revenue growth, it's just so hard to find, and that's one of the reasons why they're swinging the axe. Credit growth at the banks is okay, margin growth's just not there. It's pretty competitive for the banks. Macquarie's come in and really making them fight harder on the mortgages and the retail deposits, and they're all going hard in business banking. So they're under pressure. At the same time, costs keep growing. We don't need to tell listeners how everything costs more, wages in particular, the banks. The compliance environment is eased, but remember that the banks really bulked up to post-Royal Commission on the compliance side of things. So they're much bigger teams than they used to be. There's pressure from investors because their share prices have been going up. Now they're under pressure to grow their earnings and try and grow into their multiples. And James, we've got new bosses at 3 of the big 4 banks. I mean, you can include Bendigo in that as well. And it's much easier for a new CEO to come in and swing the axe and clear the decks, reset the agenda, reset the cost base, than an existing one. And hopefully, James, also part of this story, although I'm not sure it's front and center in our minds, is automation, AI, simplification of processes. Like, please tell me that's part of the story here. If not, what are the banks doing? It's 2025. Hopefully there's some sort of efficiency through all this. But James, do you think this is the end of the cuts at the banks?
No. I think there's more to come. And it really gets back to simple economics here. Credit growth's okay, but the banks are competing so hard against each other that their revenue growth is pretty poor. You look at it, analyst forecasts, it's poor for the next 5 years. There's no profit growth in this sector, or very minimal profit growth for the next 5 years. They'll have to keep chipping away at their costs. And in fact, a lot of their costs are just like everyone's costs, are going up naturally every year. So you have to work pretty hard to stand still just to keep your costs stable or keep your cost growth contained. So I think this is going to be a story of the next 5 years, maybe the next 10 years. Some great data from Matthew Wilson, who's a bank analyst at Jarden. He pointed out that during the 1990s, the banks cut 30% of their staff and 30% of their branches. So these things do go in cycles. Won't surprise me if we're in another cycle at the moment.
James, I've got a quick question for you from a listener, Dylan Peacock in New South Wales, who says he loves your dad-level humour.
Is that a compliment?
But he also has a question. He says, if every major bank is racing to be faster and leaner at the same time and banking is becoming more homogenous, what will actually set them apart in 5 years? Will it be technology, culture, customer trust, or something else?
It'll be the colours, Anthony, the colours of the logo. There's a yellow one, there's a red one, there's a black and red one, and there's a blue one. I'm being facetious, but I think Dylan's exactly right. We are getting very, very commoditised banking products at the moment. I've got no idea what the real difference between a NAB home loan and a CBA home loan is. Maybe one's got a slightly better app, and maybe that'll be a difference. Maybe you've got a friendly banker down at your local branch who you like. But, I mean, not many of us visit branches anymore. Nuno Matos had a great stat for us on Tuesday. 98% of ANZ's transactions are digital.
Amazing.
So I'm not sure you're going to find a friendly bank branch worker who's going to make the difference. I'm not sure what the answer is, Dylan. I think it'll probably be around technology. But I think you just need to look at the rise of mortgage brokers. They are basically saying, just come and get a loan from us. You don't really care who sells it. Rock on. I think Dylan's hit the nail on the head. The banks are really going to have to work harder to differentiate themselves.
Yeah, I'm with you, James. I think what will distinguish them is how efficiently they can offer those homogenised products, right? And that's going to come down to technology and their own in-house processes.
Yeah.
For our second topic, James, we had a bit of an Australian business moment this week. On Tuesday, just ahead of those ANZ job cuts, Rupert Murdoch and the Murdoch family announced it had sorted out the burning succession issues, which was the subject of a messy court case and years of manoeuvring and speculation. The Murdoch family trust will be dissolved. 3 of Rupert's children will be paid out US $1.1 billion each, while 3 children will borrow money and buy out their siblings. James, the end result's the company being firmly in the control of Lachlan Murdoch, who was Rupert's anointed one. He's already executive chairman of both News Corp and Fox, the two family companies. And he's joined by Grace and Chloe, who are Rupert's children from his marriage to Wendy Dang. James, it was a big settlement, right? US $3.3 billion, 5 billion Aussie or so. Lachlan's effectively buying out his 3 siblings here, James, Elizabeth and Prudence, and paying them to stay away. Who do you think got the better deal? Lachlan's side or the cashing out siblings?
I think this is one of those classic cases, when you have a negotiation and everyone walks away a bit unhappy.
Yeah.
Everyone's walking away from this thinking, oh, I'm not sure I love this, but it's probably okay. That's the sort of settlement you get when you go through a painful process like the Murdochs have gone through. This has been pretty ugly. They had a big court case that spilled into some fantastic reporting, as it always does with the Murdochs, some great reporting in magazines and newspapers about the inside infighting. And so finding a resolution to this was necessary for all sides. I think probably Lachlan's won. He wanted control of the business. He wanted to get his siblings out or keep them out of the business. And that's what he's been able to do. He's been able to convince them, and it's taken a fair bit of cash, granted, that they're better off with this settlement and they're better off to walk away. That's what he wanted. That's what he's got. He's probably the winner. By the same token, you would say James, Elizabeth and Prudence, they didn't really want to be involved and they're walking away with a big whack of cash.
So let's take a step back and look at the personal and financial costs of this settlement. It tells us how important Rupert's legacy is to Rupert and Lachlan. Why do you think that legacy is so important to protect?
Anthony, I think we got a sense of this in the court documents last year. And I can't remember the exact wording, but it was something like Rupert sees News Corp as the conservative voice of the Western world, basically. And his concern was that that voice could be altered in some way or reduced in its importance if the legacy wasn't protected by this succession from Rupert to Lachlan. So I think that's what it gets down to. Rupert sees News Corp standing for something very specific in the way it speaks to the world and looks at the world, and he believes Lachlan's going to protect that and continue it, and he wasn't so sure that the other siblings would do the same. It's funny, we always reduce these things with the Murdochs to money and power and that sort of thing. I often wonder, do they ever think, geez, we're never going to have a nice Christmas again, or we're never going to celebrate this thing, Maybe they never did those things, but you're right. It is the end of an era for Rupert Murdoch, and he clearly is handing the dynasty to Lachlan. Is there a bit of history repeating there?
Oh, there definitely is. Yeah, Rupert Murdoch, he had to do a similar deal with his sisters 40 years ago. Once again, the old family company was collapsed. Rupert Murdoch and his mother, Dame Elizabeth, were appointed executors of a new corporate structure, and then Rupert ended up buying out his three sisters at the time. Now we've got Lachlan Murdoch, who was sort of heavily involved and then stepped away a bit, and then he's been back heavily involved for about the past 10 years.
Yeah.
I think he really graduated up the ranks when he was appointed executive chairman in 2023, James. That's kind of when it was recognised that Rupert's retired. He's hand the business formally over to Lachlan.
Yeah.
But the other siblings just didn't necessarily agree, so it all kicked off. But, I mean, the deal-making behind this one, James, must have been fascinating. You had the courtroom drama building and then the settlement, and how do you do it? How do you fund it?
Yeah.
There must have been mixed views on whether to use debt or not, whether to sell News and Fox shares, whether to place the stock with a friendly investor, all that sort of stuff. But in the end, Lachlan's borrowed $1 billion.
Yeah,
it's a lot. It's a lot of money.
Big bet.
About $1.3 billion of stock was sold to help fund some of the cash. There's got to be about $1 billion US of cash coming from somewhere else as well. Pretty high stakes stuff. But Lachlan is guaranteed to be in charge of this until 2050 now, right? It's 25 years.
We'll still be doing the podcast, won't we then, Anthony?
Who knows what we'll be doing by then, James. But we have News Corp listed here on the ASX. What do you think it means for News Corp investors? Is it good, bad, indifferent?
Oh, I think it's good. The cloud that's been hanging over News Corp is what happens when Rupert dies.
Yeah.
Could the death of Rupert have kicked off some awful family fight? Well, that's resolved now. If you're a believer in News Corp, then you can sleep easy knowing exactly what's going to happen in succession, who's in charge, where the power lies, what the strategy is. In my view, I think News Corp investors would welcome this. I think they probably expected that Rupert and Lachlan would find a way to get this done and retain control. But Anthony, you mentioned the $1 billion loan. It is a huge bet by Lachlan, and I guess he's not just chips in on News Corp, he's borrowed chips in and his own chips in, and all chips are in on this company, which is in a volatile sector. You've got streaming, you've got social media, you've got AI, all these things. Think about media and entertainment. Are you a buyer or a seller? And remember who you work for.
Yeah, it's so tempting to think it's a time of great change, in content and media, entertainment, data, all that stuff that News Corp and Fox are essentially. I mean, the rise of generative AI, which basically is all about automating content, it's got to be a game changer. And, we sit in the media sector. I don't think we've seen it change a lot yet, but you'd think the writing's on the wall. There will be changes in the way content does get produced in the future. And, I mean, News Corp, they were quick onto this. They signed the deal with OpenAI, which owns ChatGPT, about getting their content fed through the ChatGPT models. But News Corp's business, James, it's far from just traditional media. It's got that 60% stake in REA Group. It's got a book publishing business, owns HarperCollins. It's got Dow Jones, which is basically a data and analytics business.
Yep.
Media, real estate, books, and Dow Jones, they all contribute about the same amount in terms of revenue, about US $2 billion a year. The earnings, though, are skewed towards REA and Dow Jones, which are those, capital light, high margin growth businesses. Surely AI automation is changing them already. They're obviously trying to embrace it. But all of this change was Lachlan's problem and opportunity before this deal, right? Like he was the one. He was executive chairman of the company. He's ultimately responsible for it. Now he's also got pretty much full financial responsibility for it as well. So it just ups the stakes for him, I think, even more.
Yeah, the one thing I'd say, Anthony, is the Murdochs do have history on their side. You know, there's been a hell of a lot of change over the last 50, 60 years that they've managed to navigate very, very well. And, you know, I guess that's what a lot of News Corp investors are doing, backing them to do that navigation well once again. All right, Anthony, we'll come back after the break. We get the next key bit of data for the RBA's interest rate call next week. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, relatively quiet start to the week on the data front. We get some Chinese economic data. On Monday, industrial production, I think retail sales. On Tuesday night, we get US retail sales, which will be interesting. We're very focused on how the US consumer is holding up as tariffs kick in. But Thursday, I reckon's the big one, Anthony. Employment data, which will be the next big thing the RBA looks at to figure out if the economy is softening enough to warrant further rate cuts. What do you reckon?
Yeah, absolutely. It's the same things playing out in the US at the moment. Employment numbers have sort of shot to prominence again. If everyone knows that the central banks are looking at inflation and the jobs numbers and inflation's not gone all together. The question is just whether the jobs are going to be weak enough to get the cuts coming through.
Yeah. There has been some interesting data on what economists call the non-market sector of the economy. So that's like government jobs or government-related jobs. Think of healthcare, education, that sort of stuff. They had been growing quite slowly, but the growth is starting to come off. And so there is this question, will the private sector in Australia step in and start boosting employment? And after a week of job cuts from the banking sector, Anthony, I'm not so sure about that. So let's see what the data brings us on Thursday, I guess. All right, we love questions here on the Chanticleer podcast. This week, our question is from Liam in Sydney. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. As I said, we've got an audio question this week from Liam in Sydney, and a shout out to Peter from Queensland, who wrote in with a very similar question. So here's Liam.
Hi, Chooks. Love your pod. My question is, what do you think the impact on the Aussie dollar and our economy will be from President Trump getting control of the US Fed? If he dramatically cuts interest rates, combined with the stalled US housing sector and the stalled economy, plus price increases from their tariffs and the labour shortages from targeting the 14 million undocumented immigrants, or will this just be the next global speed bump? Thanks. Look forward to the Chook's wisdom, as always.
Well, Liam, that's a very cheerful picture you're painting for us out of the US. I guess what I would say is the market's clearly concerned about the White House leaning on the Fed and trying to artificially suppress interest rates. It's a big topic of conversation. But at the moment, strangely enough, I think the cracks in the labour market in America are actually reducing concern about Fed independence. The concern about Fed independence is that the White House forces the Fed to push interest rates down and inflation explodes. You juice the economy, you add in the tariffs, and we got inflation kicking up, which of course bond investors hate, and that would force the US dollar right down. But at the moment, because the labour market is weakening, the markets are less worried about inflation getting out of control. So strangely enough, this Fed independence debate has been pushed to the side by the focus on the labour market in America. And I think that's the important thing to watch, Anthony. Am I missing anything there?
I mean, the US dollar is a big part of what Trump's doing and what Trump's trying to do. I mean, he's pretty keen, isn't he, to weaken that US dollar, helpful for the US terms of trade, should drive up the value there. Exports makes imports more expensive.
Yeah.
which is not an easy one to get through, but it feels like he's trying to reduce the reliance on the US dollar globally. Even look at the Australian dollar exchange rate against it. It's about 62 cents now, with 67 cents at the start of the year. So the US dollar is weakening. If you look at the US dollar index, which is sort of like a bag of currencies that you can see how the US dollar's gone against, it's the lowest it's been in 3 or 4 years. So, I mean, the dollar's right at the heart of it. But, I mean, good luck to anyone who thinks they can predict where the US dollar's going. The FX strategists all seem to say it's going lower, but mate, there's just so many moving pieces, rates, inflation, economic growth, trade, liquidity.
And Australia's monetary policy position plays into that too. If we keep pushing interest rates down, our dollar weakens as well. So there's a lot at stake here, but yeah, I think you're right, Anthony. The general view is that the US dollar's heading down around the world, but let's see whether Trump puts some extra momentum behind that. All right, Anthony, a big week. Great to see you at the Asia Summit, and we'll keep an eye on these banks next week and see if anyone else has got the axe out.
Yeah, hopefully that's the end of it for a while, James.
Thanks for joining us, everybody. We'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Mandy Coolin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.